economy or not. Chris Thornberg is founding partner of Beacon Economics. He thinks the Fed can still avoid a sharp downturn. Jay Bryson is chief economist at Wells Fargo Corporate and Investment Bank, and he expects more of a hard fall into recession. Welcome to both of you. Chris, we'll start with you. And do you see soft landing only if the Fed starts to pull things back here?
Well, listen, if the Fed raises the federal funds rate to 12%, we can all agree we're going to have a recession, right? Now, I do think the Fed's going to start backing off. We know they weigh unemployment far more heavily than inflation when it comes to their decisions. They're very worried about overdoing it when it comes to the labor markets, and they'll probably start to back off as a result of that. But with that in mind, of course, the big question you're asking about is what about this recession we're supposedly about to have? You know, it's intriguing. That's been a watchword for the entire year. And my question has always been, why? Why do you think we're going to have a recession? Inflation, to be clear, is not hurting consumers. It's being pushed by excessive consumer demand. And consumer demand has been overheated by the massive amount of stimulus the government unnecessarily put into the economy over the course of the pandemic. Households are still sitting on trillions of dollars in cash, $5 trillion holdings as of this morning, 5 times what it was pre-pandemic. And that will be enough to push the economy through the troubles from interest rate sectors and sensitive sectors like housing. So I just don't see a recession on the basis of strong consumer spending.
Yeah, the consumer piece of this is hopefully a stalwart. Jay, we turn to you, though. You're expecting more of a hard fall here. Why is that?
Well, it comes down to inflation, Kelly. I mean, inflation is having 2 issues right now. The first is it is eroding real disposable income. You know, in October, year over year, real disposable income was down 3%. At the same time, real spending was up 2% over that period of time. So we're seeing the household saving rate is essentially at an all-time low right now. Credit card debt is going up. And so the fundamentals of the consumer are starting to weaken. And then you throw on top of that the fact that the Fed's not done. The inflation, in our view, is their #1 priority right now. And so the combination of weaker consumer and higher interest rates, I think, leads to a modest recession next year.
It's curious that you guys differ pretty strongly on the consumer. Chris, why aren't you more concerned about those signs of weakening that Jay's picking up on?
Well, Jay's talking about income, and I'm talking about wealth. That's the primary difference here. Jay's referring to some of the ebbs and flows over the course of the last year, which I don't disagree with. But again, what is driving consumer spending is not income. It's the wealth numbers, which are up fantastically. Again, we just got the third quarter flow of fund number. My favorite number on there is cash on hand. Prior to the pandemic, all households were hanging on to about $1 trillion in cash liquidity. Right now, $5 trillion of cash liquidity. That's a phenomenal amount of cash burning a hole in consumers' pockets. And that's going to continue to keep consumer spending up and running right through this problem. Indeed, I'm going to start worrying when inflation does slow down, because slowing inflation means a weaker consumer, and that in turn suggests that my primary, shall we say, driver of the economy next year may not be showing up. But boy, we're not seeing any of that now.